Hello and welcome. This is Abhinav. In this video, I am discussing about this practice by NRIs, non-residents, who invest in India in their parents' name. So basically, I want to highlight the risks involved in that kind of a structuring. Okay, so basically, as per FEMA regulations in India, a person who is resident out of India can only invest through NRO, NRE accounts and certain investments. They require compliances. Like, for example, if you want to invest in shares, you need to invest through a PIS mode, or if you want to make a direct investment, then it qualifies as a FDI, and the proper formalities around that need to be done. So basically, important thing to understand is that the moment a person becomes a non-resident, the Indian government basically wants to track whatever the money that is coming in India through the non-residents and going out of India, which is being tracked through the outward remittances, right? So there is a very clear cut laid down procedure under the FEMA, Foreign Exchange Management Act, right? So what basically, when you invest through your parents name, so generally what they do is that investing to the gifting to the parent, and then the parent gifting back after some years. This is basically what you're doing, is that it's a you're principally contravening the FEMA requirement of the Indian government, right? Which says that if the NRI is investing in India, he has to fulfill certain formalities, certain procedures, and you are trying to bypass those procedures, right? So general practice is the NRI invests in parents' name, and why? Basically to escape the FEMA compliances. See, people are sometimes lazy; they don't want to convert the accounts that they have into PIS accounts and all those things. And some people, even NRIs, they keep resident accounts even after becoming a resident, non-resident. These are all basically one reason is non-awareness of the FEMA regulations. So as a NRI, you need to be very important thing. So they are aware of the tax compliances, right? But FEMA is generally ignored. But FEMA is more dangerous. Tax, at least there is a, you need to, if there is a violation, you need to pay a penalty and everything. But FEMA, the implications, you get a notice from the ED, right? And the implications are very different, right? The penalty is three times of the amount of contravention. And even if you go for compounding, then you need to first, is you need to kind of reverse the whole transaction, right? So the generally what they do is that to escape the FEMA compliances while investing in India, or to escape, some people what they do is the US NRIs, they want to escape the punitive tax regime on PFIX. So they want to basically invest in Indian mutual funds and ETFs, which are qualified as a PFIC in US, right? So they want to escape that particular regulation, and they also want to escape the US tax liability on the Indian investments. So what they do is that gifting the investment to the parent investments remain in the parent's name and tax in the parent's name. There is no tax to them in the US. So all that thing, because of that, they do try to do. Now, in my view, this practice carries basically two risks. One is the risk of tax scrutiny, a scrutiny by the income tax department of the parent's case, and the FEMA non-compliance, right? So the tax risk is that in this case, what is happening is that the investment is done by the parent, and the investment is reported under AIS to the income tax department. But the parent is offering either even some, the laxity is so much that some individuals, they don't even ask the parents to file a tax return. So if the return is not filed straight away, it will be a big risk that the income tax department can, ask for the details. Or if the return is filed, the income of the parent is almost, parents are generally retired, so they don't have an income, right? Very less income. Against that, a very big amount of investment is made in shares, mutual funds and everything. So that can cause a scrutiny assessment to be opened up of the parents return, right? And then what happens is that the onus is on the parent, and the onus is basically on the parent, the assessee, to prove the source of fund. So basically, then you have to prove that this fund was actually a gift made. So see, the here the presumption is, the income tax department holds a presumption that the funds are bogus funds, right? So that is the presumption that they, work with. And then you have to, that means the parent has to prove that this is basically a gift from the child, and this gift is being invested, right? So that's why very important, if you do this kind of a structuring, that there is a proper gift deed that is there to prove, right, that there or some documentation around the gift. right? And the onus is on the parent and the child to prove the source of funds. So for example, the child has earned a lot of income in US, and then the child has to provide the W2 and the 1040 and everything to prove that these were s- tax paid funds, genuine funds on which tax was paid in US, right? So that onus and that litigation, again, that whole process of litigation is involved. Now, FEMA risk. See, tax risk is even, I will say, smaller. The main risk is FEMA risk. So once the return is opened, there is no bar on the income tax department to not pass the particular case to any other regulatory authority. They have full freedom. If there is, like, for example, a violation of customs or violation of FEMA, so they have full right to pass those details to the relevant authority. So if the case by any chance is forwarded to the ED for a FEMA contravention risk, then that's a bigger problem, right? And at the tax, it's not only at the tax return stage, but even after the tax return, if at the time of outward remittance, so for example, you give the gift today, and then after 5 years down the line, your parent again gifts back and it's a significant amount, then that particular thing can be, questioned, that on that outward remittance, if there is a flag and then there is some inquiry, then it can be questioned that the both the gifts of gift as well as the reverse gift done by the parent are sham transactions to avoid the FEMA compliances by the NRI. And there are also recent news reports, if you have seen in the recent past, there are news reports that the government has increased scrutiny on the outward remittances in excess of 6 lakhs, right? So this is, in my view, very harsh provision, because although there is existing provision with respect to TCS at the rate of 20% on the outward remittances, even then, so all the information is available to them, still they are doing increased scrutiny on the outward remittances. Uh, so that risk is there, that it can be also flagged at the outward remittance stage. So now, basically what is the transaction of gift and the reverse gift by the parent is are both sham. Actually, they are transactions just to avoid the FEMA compliance. So that if the RBI or the ED, they hold that transaction to be a sham transaction, then the process is that, for example, the amount is like 1 crore. So the penalty under FEMA is 3 crores, three times the amount of gift. And then the RBI or the ED can ask the person to go for compounding. So in compounding, what you have to do is that you have to completely reverse the transaction. That means whatever are the investments that are in the name of parent have to be liquidated. Amount comes in the resident parent account. Then it has to be again sent back to the child in the US or whichever country he is there. So that first that transaction has to be reversed, and then there is a compounding. In the compounding order, then there is some penalty, which is not that much, three times, but there is some penalty that is also considerable, right? And if you don't pay that penalty, then though it's like a FEMA contravention, and the according the provisions will be implemented, right? Okay, reversal of transactions, penalty on undue gains. Even for example, if like 1 crore was the fund investment amount, and that investment amount is now 2 crores, so that extra 1 crore also that will be counted for the purpose of the penalty, right? Now, I could not find any judicial precedents or compounding orders till now where these kind of transactions have been questioned. However, this doesn't mean that the risk is not there. In case of significant amounts, or if you are in plain bad luck, right, that risk is always there, that this kind of a transaction can be questioned. So my only request to NRI is non-residents, and non-resident is different as per FEMA and as per Income Tax Act, right? So please first assess whether you're a FEMA non-resident as per FEMA. So if you're doing business or job in US or any other country, you are most likely a non-resident as per FEMA. So consider this risk exposure, and especially the FEMA risk exposure in case of such a structuring. My only advice is that in case of significant amounts, always ensure that you invest directly in India as per following the proper process of PIS, and investing through a NRO NRE account only, not a resident account. Because the biggest problem is that when you invest through NRO NRE, people think that it is nothing, it's a small requirement. No, it's a very, very big requirement. For example, if you don't, for example, a resident person is there, and a non-resident is there who is making certain transactions in India through a resident account, that all the transactions, especially acquisition of property outside India, all these transactions, significant transactions, they have to be reversed. That means if you have like a resident account in India, you have funds in resident account, you buy a property in Dubai from that particular account, you can be asked to reverse that transaction. That means sell that property in Dubai, bring the funds back in the resident account, convert into a non-resident account, and then apply for compounding under the RBI compounding rules. So just please ensure that you take care of these precautions, and also take care of the FEMA risk exposure, and then finally it's your choice what you want to do. I am not unnecessarily kind of making an alarm on these things, but these are important things. And the thing is that you consult a lot of consultants and CAs, and everyone will say that there's no judicial precedent, or it's a fine, and chalta hai, it's a accepted practice. But when then kind of an ED notice or something comes, then the same CA will tell you that you have made a mistake and you should have done it in the proper way. So please take care of that risk exposure, and then only do the transactions. Now if you have, now your question will be, if I have already done the transaction, see, the only thing is then reverse the transaction, and if you want to be totally risk free, go for compounding under FEMA, right? So see your situation, check with your consultant. Consultant should be uh, 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 well conversant with FEMA. Then decide what you want to do. If the amounts are significant, then see your risk appetite also. If you get a notice, you have to just then undergo the litigation, get a consultant, have go into through the litigation process and all. So see that risk exposure, and then invest. If you have existing investments, decide accordingly, check with your consultant on this. If it's a genuine gift, I always advise that you execute a gift deed, a proper gift deed, signed gift deed, or if it's a small amount, at least an email kind of conversation where you give the gift and the parent accepts the gift, so that any kind of a uh, 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 kind of a documentation should be available. In significant amounts are involved, like a 1 crore transaction, you need to have a gift deed in place, right? Must have a gift deed in place. Retain the source of funds documentation. So for example, if you have gifted your parent 1 crore and that amount has been invested, you need to have a source of fund documentation for that 1 crore, and you need to have keep it indefinitely. Don't think that, okay, 3-4 years have gone and no question has been asked, so I will just destroy the evidence, the destroy the documentation. No. You need to have a proper documentation of all the amounts that you are remitting to India, because the Indian tax authorities always have a right to question that amount. There is no like a provision in the Income Tax Act in India or the FEMA that any amount remitted by a non-resident to India will not be, it's free, it's totally an immunity is there, no source of funds will not be asked. No, anything that gets credited into an Indian bank account can be questioned by the Indian authorities, maybe tax authorities, maybe FEMA authorities. So you need to have a proper source of fund documentation, because the onus is to prove the genuineness of the source of funds of the particular amount is on you and not the tax department, right? And you need to preserve them indefinitely. Why indefinitely? Because in FEMA, at least in Income Tax Act, at least there is a now a 5 year period beyond which the income tax department cannot open your case. But in the under FEMA, there is no such limitation. Even if it was like a 30-40 year back investment that is there, it still can be questioned and you can still be penalized for it under FEMA. So FEMA is a much higher risk kind of a law as compared to the Income Tax Act. So you need to preserve all the documentation in India, and also please develop your understanding on the FEMA law, right? Okay, so this is all what I wanted to say. I hope this video was useful to you. Thank you so much for watching this video.